Hello friends, this is Sanjeev Kaushik and welcome to my channel Methodical Trades. In this video, I'm going to share with you 5 unwritten rules of trading. If you're a beginner or even if you have slight bit of experience, I'm hoping that these rules will help you refine your trading even further. So let's get started. Rule number 1, trading should be an exception. This is especially for those who feel compelled to trade every now and then, right? Sometimes we may not come across enough trading opportunities, but because there are not a single trade that we are seeing in our account, usually we'll be compelled to take a trade from here and there. So what would happen is either you would look very aggressively for trades, and even though there are no trading opportunities, you would still end up taking one. Or maybe you're here from somewhere else, maybe a news channel or any kind of those tips and related sources where people go and find trading tips, but they usually don't work, right? So you'll end up relying on all these sources. If you have a proper trading system and if it's not generating any signal for trading, do not do it. That's why I'm saying trading should be more of an exception. More often than not, stocks do what they have to do, right? But if we have to find trading opportunities, it should really be an exception. It should be the best trade that you're going to take. But how would you know that it's a best trade? Go back in past, and if you have been trading for a decent period of time, then you would know at least 5 to 10 trades from past that worked wonderfully for you, right? You didn't have to do anything. You just put on the trade and it went in your favor right away. And the charting patterns or whatever was the signal that you relied upon, whichever is the system that you're using, right? It worked perfectly. Take a snapshot of that chart, right? Keep a note, a mental note of what kind of trades that you should really be looking at, right? And if you have a mental note of only, let's say, half a dozen types of charts on which you'll be trading, half a dozen types of trading signals on which you'll be trading, because in past they worked wonderfully for you. Unless you find a trading opportunity that is as good as the ones for which you have created your mental notes, you will not trade. Trading is not about taking dozens and dozens of trades and then being profitable. It's about picking up the gems out of the roughs in the market. So I hope it's clear that we should trade less, but only trade when the iron is hot, when we know that the money is literally lying out there. All we have to do is stretch our hands and grab it. Now, unwritten rule number 2. Should you add to the losing position? Answer is never do that, right? And this is not really unwritten. As they say, only losers add to their losing positions. So never add to your losing position, but there is always a difference. And let me take an example of some fundamental analysts. A fundamental analyst would look for value in the market, right? So they have done their own mathematical calculations and they know that this particular stock is cheap at this particular level. As and when the stock will come to that level, they will buy more. Right? And they could be buying to average out, or they know that this is the fair price of this particular stock. Would you call that they are adding on to their losers? Because the stock has already come down and they're buying at a certain level. There are chances that they're probably averaging out, right? They might have bought at the higher level and now they're averaging down their overall cost of holding that particular stock. Actually, when you're adding on to your losers, there should be a method behind taking that kind of a step, right? You should know what you're doing. And that's why I took an example of fundamental analysts, because what they usually do is they do not chase the stock, which is what the technical analysts would do. Technical analysts believe that if a stock is in an uptrend, it will remain in an uptrend. A fundamental analyst, on the other hand, would look for a stock to dip a bit so that it comes to their preferred price range where they want to purchase it, and then they will start adding on to the position. If the stock went up, fine, and if it comes back down again to the same level, they'll buy again. So they might end up doing dollar cost averaging, right? This is about adding on to your position. When you are adding on to your position, you should know why you are doing it. Just blindly adding on to your position because you're already running mark to market losses and you're hoping that if you will add more, you will get an exit price which is much closer to the current trading price, and you will hopefully not have to take the stop loss. This is wrong, right? If your stock has come closer to, let's say, your stop loss range, exiting is the best policy, not adding on to the position. However, within this rule, I want to make a distinction between a throwback trader and a breakout trader. A breakout trader usually trades in two ways, or in other words, a breakout trader takes position in one of the two ways. Number one, let's say they have a proper signal in place and now they're waiting for the stock to break out of this range. What they will do is the moment the stock will break out of that range, they'll take the position. As the stock will keep going higher, and assuming that they have taken a long position, they'll add on to their position until they reach to a level, or their position size reaches to a level where they know that this is the position size they want to trade with. That's the first way how a breakout trader would trade, right? Now, when they do it, and let's say the moment the breakout happened, but the breakout didn't sustain and the price dipped. In such scenario, they wouldn't really lose too much. They would have, let's say, added only 20% of their original position size that they wanted to take eventually, right? So with only that 20%, they will take their losses and they will exit. However, if the price kept going higher, then they keep adding on to the position and the overall entry position or entry levels for them are at a much favorable price, right? So that's one way how breakout traders would trade. The other way how breakout traders usually trade is they would wait for a proper closure above this particular level, right? So let's say if they are trading on a daily chart, they will wait for the daily candle to close above the breakout level, and then only they will take their entire position on that particular stock. However, there is another breed of traders as well, and that is a throwback trader. Sometimes a single trader might trade in both the ways, right? They might also trade on breakouts and they might also add onto their position whenever a throwback happens. So what is a throwback? Sometimes when the price breaks out, it comes down for a bit to again test the levels at which the breakout had happened. And this is usually called throwback or a pullback. What traders usually do is they would either add on to their position when the throwback happens and they already took a position on breakout, or they will initiate a new position when the throwback happens, it is confirmed, and the price starts bouncing back again by taking the support at the breakout level. What kind of a trader you want to be? Sometimes you're going to be a breakout trader, sometimes you're going to be a throwback trader, right? You can't really generalize yourself and say, I would only trade on throwbacks or I would only trade on breakouts, right? So there are horses for courses. You would oftentimes see that you're looking at a chart where you missed out taking an entry on a particular breakout. However, now that the throwback is happening, then you will keep a very close eye on that particular chart. And when the throwback is confirmed and the price would reverse from the support levels, you will take your position. The reason I'm talking about throwback versus breakout trader is when the price has already given a breakout and now that the throwback is happening, if you're an experienced trader and if you want to add on to your position, even if you're running mark-to-market losses and if you're adding on a throwback, you're not really adding to a loser, right? Because you know the reason why you're doing it. And that's very, very important. Yes, losers add on to their losing positions, and we must never do that. But as an experienced trader, you should know a clear distinction between trading on a throwback, trading on a breakout, and adding on to a losing position. I hope it's clear to you, and that's why I covered this entire distinction between a breakout and a throwback trader. Now, let's move on to unwritten rule number 3, that is right strategy, wrong timing. Let's say you are following your system to the T and you have been trading very profitably on this system for a very long time. You trust this system. However, you would see that this system has been often giving you, say, long signals, and you have been taking long positions as a result. But you're seeing that a lot of your positions are hitting stop losses. In this case, we can't really say that your system is not working. Perhaps it's the wrong timing, right? Maybe there are false breakouts happening. Maybe the markets are trying to go up, but the selling pressure is really too strong. As I am recording this video, I look back in past 2-3 months trade of mine, and I saw that my success rate on long positions are less than 50%, but my success rate on shorting positions are over 70%. Does it mean that I should have only taken the short positions? In hindsight, yes, but I have to trust my system, right? If my system has been giving me long opportunities, I shouldn't really avoid those, because I should not forget that about 45% of my long positions have actually worked. So even in a bearish market as of today, my strike rate is still not that bad, especially considering the fact that barely any stocks are performing or outperforming the broader markets, right? So sometimes what would happen is you may be following a right strategy, but the timing would be wrong. You will not have any control over it, but by keeping your position sizes in check, not taking risks too aggressively, not taking too many trades, always following the rule of trading by exception would help you curb your losses, and you will be able to survive the hard times, right? This brings me to the next unwritten rule of trading, and that is position size elasticity. You should be very flexible when it comes to calibrating your position sizes. As I mentioned, in last 2 months, less than 50% of my trades have been going right on the long side. Now, this is an analysis I did just a few days back, which is what I often do on all my trades. But about a month ago, I had reduced my position sizing on long trades by 25%. So if I used to trade with, let's say, 4 futures contracts, I reduced the size to 3 futures contracts. That definitely meant that I would be making lesser money on my long positions, but at the same time, I would also be losing lesser money on the long positions that will not work. So if you're seeing that one side of the trade is not really being profitable, then what you can do is you can reduce the position size. And you can also do the exactly opposite, that is increase the position size on the other side, right? So if I would have shorted, as I mentioned, about 70% of my shorting trades actually worked wonderfully. I would have shorted with slightly bigger position size. I would have made much more money by doing so, right? And this is what a position size elasticity means. Knowing what kind of trades are working for you in what kind of environment, right? Yes, of course, your strategy is right, but your timing was wrong. The markets are really punishing the long positions. So there's nothing you can do. You have to trade on the signal, and you traded, but your success was really not that great. So what you would do is, as a result, you will try to make sure that you are being flexible on your position size. In general, the position size elasticity should also apply to your winning or your losing streaks. When you start hitting a consistent winning streak, you should slowly look to increase your position sizes. And when you are seeing that you're consistently taking losses on your position, look to reduce your position sizes. Sometimes after taking a whole bunch of losses in a row, our confidence gets shaken and we fail to take the next particular trade. Who knows, maybe the next trade is going to be that winning trade that would have boosted your confidence once again. But because you were too scared to take that particular trade because of what happened recently, you are going to miss out on the opportunity of making money and also regaining your confidence. In life as well, in general, our immediate next decisions that we take are based on the immediate past experiences. So it's not just trading, it's in general as well. Our next step will always be influenced by what happened with us in immediate past. And therefore, position sizing will make sure that you're not only trading in the right direction with the right position size, but also when you are hitting a rough patch, you're able to control your emotions, you're able to control your losses. And when you have hit a purple patch where your trades are going in your direction, it means you're doing something right. Why not maximize while you're still there, right? So there's no harm in increasing position size as long as your overall risk levels do not really go so high that if those profit making positions have to go in losses, you will end up losing, say, 10-15% of your capital. Do not increase to that level. Just maybe if you have been trading with, let's say, 4 futures contracts, this time you can go with 5, right? So that's how we should be a little more flexible when it comes to position sizing. And last but never ever the least, rule number 5 is it's not your fault. It happens with everyone. Sometimes we blame ourselves for taking so many losses from the markets. There are good chances that maybe you are responsible for that. Maybe you did reckless trading, right? Maybe you took position sizing which are way too large for your own trading account, right? However, this rule is for those who have been trading profitably for a decent period of time. Let's say 6 months. You found a strategy and you've been trading on it for initial 5 months. That worked wonderfully. However, 6 months you are taking on some losses on it. Maybe there's nothing wrong with the strategy, and there's also nothing wrong with the way you're trading on it. You're still following the same rules. But sometimes the markets can be a little more punishing to traders, right? So it's not always your fault. And mostly, we feel that it's our fault when we hit stop losses in a row, one by one. And that's when we say, it's us, right? It's my fault. Why me, God? All of a sudden, the religion creeps into Wall Street or Dalal Street. You should never think too much when your stop losses are being hit. Stop losses are really good. They're stopping you from taking further losses. So there's nothing wrong with that. Sometimes you will have to just manage the losses a little more often than you really want to. But this is just a part of it. Do not blame yourself too much. Do not be too harsh upon yourself. Do not punish yourself, right? It's not always your fault. Just be mechanical with your trading, right? You take a stop loss and you move on, right? Look for the next particular trade. As long as you're able to survive in the market, it should be fine, right? So try to be nicer to yourself when you are taking stop losses. Your account is already bleeding. Just make sure that you're not bleeding emotionally. But the flip side is, it doesn't mean that you're not doing anything wrong, right? You should always check back what is it that you are doing wrong. As a result, you are hitting a streak of stop losses. Sometimes you might find a fault, right? But if you know that there's absolutely no fault, even after going through your previous trades, you know that the same trade would have worked, but now it did not, then do not punish yourself. But always, always, always do your homework. Just don't say that, okay, fine, I saw it in the video, every time the stop loss is hit, it's not my fault. No, it's not what I'm saying. What I'm saying is, if you've done everything right, and if despite that you are hitting stop losses one by one, maybe it's not your fault, right? Just stay out of the markets for some time and then come back, right? So this is all that I wanted to cover in this particular video, the 5 unwritten rules of trading. Let me know if there are any unwritten rules that you also follow. I would be very keen to add those to my trading strategies. Thank you for watching, and I'll see you soon. You're still here? Maybe check out all these other videos that are flashing on the screen.